New borrowers are becoming increasingly interested in options that can assist them in reducing their initial mortgage payments as mortgage rates climb to 7% and above. These borrowers hope the rates will have fallen sufficiently in a few years to permit them to refinance their homes and permanently bring down their monthly payments. Temporary rate buydowns and down payment assistance programs are two options available to borrowers. Many loan officers are unfamiliar with temporary rate buydowns, but they are not new to the market. Historically, periods where they gain popularity are typically accompanied by an increase in interest rates. Hello and welcome back to the Finance Guardian channel. Interested in learning more about this 2x1 buydown and how it works? Here's the perfect video for you. So hit that subscribe button and bell beside it and let's get started. A buydown is a real estate financing technique designed to assist borrowers in qualifying for a mortgage at a lower interest rate. That lower rate may last for the entire mortgage term or for a certain period. One temporary buydown that lasts for a certain period is the 2x1 buydown, which lasts for 2 years. With a 2-1 buydown in your first year as a homeowner, you will pay 2% less interest than your standard rate. The second year will feature a 1% lower interest rate than the agreed upon rate. And once the 2-year period is over, the permanent interest rate on your mortgage will begin to apply. Upon closing on your home, a one-time fee or point is paid to offset the difference. It is usually deposited into an escrow account, and a small amount is paid out every month to cover the difference. The process allows you to essentially buy yourself a lower interest rate for 2 years. You may find a 2-1 buydown appealing, especially if you do not have to pay an escrow fee, but remember that it is the lender who will determine the exact details of your mortgage. How does a 2-1 buydown work? A 2-1 buydown loan requires the borrower to pay a lump sum upfront, thereby ensuring a temporary reduction in the interest rate during the first 2 years of homeownership. Let's look at an example to help you better understand the concept behind it. Suppose you purchase a $250,000 house with a 5% fixed interest rate and agree on a 2-1 buydown. You have to pay 3% interest in the first year of homeownership, and your monthly mortgage payment will be $1,337.34 during that year. As soon as the first year is over, your interest rate will increase to 4% and your monthly payments will slightly increase to $1,476.87. Once the 2 years are up, you'll begin to pay your permanent interest rate of 5% and your payments will remain at $1,766.17. If you choose this arrangement, you can save money on your monthly mortgage payments during those 2 years. You will save $428.83 per month during the first year of your 2-1 buydown and $289.30 per month during your second year. You must, however, pay the difference of $8,617.56 upfront and deposit it into an escrow account. Note that during the home buying process, you may be able to negotiate for the builder or seller to cover the fee associated with a 1-2 buydown. Your real estate agent can assist you in negotiating this during the offer stage, especially if the home has been on the market for a long time. What are the pros and cons of a 2-1 buydown? When home sellers agree to a 2-1 buydown as a seller concession, it can sometimes make the sale of their homes easier and faster. Meanwhile, home buyers can benefit from a 2-1 buydown in a few ways. During the first 2 years of a temporary buydown, the borrowers have more money available than they would have if they had paid the full mortgage. They can use that money to furnish or renovate their new home or save for other financial goals. With a 2-1 buydown, new homeowners can also ease into paying a monthly mortgage by starting at a lower amount. Aside from that, the 2-1 buydown offers a buyer time to grow their earnings before they are required to pay the full amount if they anticipate that their income will increase over the next 2 years. Finally, for borrowers who plan to refinance in the future with a lower rate, using a seller concession to purchase a 2-1 buydown will result in greater savings than paying a larger down payment with their own funds or buying points to permanently lower the interest rate. As far as cons go, a 2-1 buydown can have a high initial cost and may only be worthwhile if the buyer is able to obtain the buydown through a seller concession. The seller pays the buydown as part of their closing costs to assist the buyer in reducing their closing costs as a seller concession. The payments will increase after the first and second years of the buydown before stabilizing in the third year. Thus, the home buyer will be required to adjust to the larger payments over time. The risk is also present if they count on an increase in income to keep up with the increased payments. Finally, if their escrow agent is unable to send the buydown payments, the home buyer will be responsible for making the additional payment. When it makes sense to use a 2-1 buydown. If home sellers are having difficulty selling and need to provide an incentive to find a buyer, they may wish to consider offering and paying for a 2-1 buydown. A buydown can benefit borrowers if it allows them to buy the home they want at a price they can afford. However, they should also think about what would happen if their income does not rise quickly enough to cover their future payments. There is also a need for buyers to ensure that they are getting a fair price on the home in the first place, since some sellers may increase the home's price to cover the cost of the 2-1 buydown. It should be noted that some state and federal mortgage programs and lenders may not offer buydowns. In the case of fixed-rate Federal Housing Administration or FHA loans, 2-1 buydowns are available, but only on new mortgages, not refinances. Terms can also vary from lender to lender. The break-even point. The break-even point determines whether a buydown is worthwhile. The break-even point is the amount of time it will take to recoup the costs of the discount points required to lower your interest rate. You calculate the break-even point by dividing the discount points by the monthly savings. Here is a simplified example of how this would work. If you want to get a $400,000 mortgage for 30 years at a 5% interest rate and your lender charges you 4 points to reduce your interest rate by 1%, you would first determine the cost of the points. Considering that each point costs 1% of the purchase price, the total cost would be $16,000. Instead of paying 5% interest, you would pay 4%. Your monthly mortgage payments would therefore fall from $2,147.29 to $1,909.66. Therefore, your monthly savings would be $237.63. If you divide $16,000 by $237.63, you get $67.33, which means 67 months is the break-even point. You'd have to spend about 5 years and 7 months to recoup the money you'd have to spend on discount points. If you as the buyer think that you will sell or refinance before the 67-month mark, a buydown would not be a smart move. Instead, you should consider making extra payments, as you can also save money on interest by paying off your mortgage early. Do buydowns have any limits? As certain restrictions apply, you should consult your lender if you are interested in a mortgage buydown. Buydowns are available only when purchasing or refinancing primary residences and second homes. The buyer generally needs to qualify for the standard interest rate of the 0-point loan to buy down a home loan. Investment properties. No buydowns are available for real estate transactions involving investment properties or cash-out refinances. However, points can be bought down on a refinance if not backed by the government. Type of mortgage rate. An adjustable rate mortgage or ARM is generally only available on plans with a minimum 3-year rate period. State-specific regulations. In some states, seller subsidies are limited to prevent home prices from being overly inflated. Thus, in some areas of the country, there is a limit on the number of points sellers or buyers may purchase on behalf of buyers. Government-backed programs. Federally funded programs also have restrictions. With FHA loans, for example, temporary buydowns may only be permitted with fixed-rate loans used to purchase homes. Therefore, FHA borrowers are not permitted to buy down their mortgages temporarily if they refinance their home or obtain an ARM mortgage. However, the permanent buydowns are permitted. With mortgage buydowns, buyers can usually reduce their monthly mortgage payments permanently or within the first few years of the loan. By paying discount points at closing, buyers are able to reduce their interest rate slightly, which can bring about long-term savings. Nevertheless, not every buyer is a good candidate for a buydown. If you are considering a buydown, you should compute your break-even point to determine if the upfront cost is worth the time it takes you to recover the points you have paid. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new, subscribe to our channel to remain updated about our future videos. We'll see you next time.